Good morning, all of you. We have just last time just discussed about the installation of a credit risk rate model for a financial organization, and we have gone through the practical aspects and the model constructs. I think if you can do it in an effective manner, it is a test for your knowledge and competency on credit risk management. Because you have to think soundly for the installation of credit risk rating model in your organization. It will give you so much of benefits, not only your organization, but to the whole financial system. Because the systemic crisis generally originates from individual banks. Therefore, towards avoiding a systemic crisis, risk rating models are very important. So we can summarize what we have done last time. And I expect you all to come up with your queries and different problems, issues in the course of installing a risk rating model in your organization. So there can be several issues you would have to face, and you have to get some idea about the constructs and the mechanics of that. We have just assigned about 2 sessions for the same thing, but I think it is worthwhile to further discuss the models, because you need to have a good understanding about them. Just to do a routine exercise would not help you. Either it won't help you or your organization. And I think since we have gone through a rating model where you can give a grading or risk grading for the obliger and the facility as well. Now, when you do that, you have from 7 to 10 obliger gradings, and sometimes 6 or 7 facility gradings. As it is, the obliger gradings are related to the respective probability of default. Because the grading of an obliger gives an indication about that obliger's probability of default or default frequency. So that is the indication of the grading. In order to have a better indication, most banks try to map those gradings with international external gradings given by globally recognized rating agencies. So that exercise is also important in order to get an idea about the level of risk of your obliger. But it is not so simple. On the other hand, the facility rating gives an indication about the loss given default or the recovery rate. Now, I think for an organization having two different rating scales, that is for facility and the obliger, would pose some issues. Therefore, most of the organizations have a mechanism to have a consolidated rating. So that consolidation is done through now we said that obliger rating is connected with the probability of default, and facility rating is connected with the loss given default. So the consolidated rating is connected to the expected loss. It is fair enough. Now you all know the expected loss is a multiplication of probability of default, loss given default, and the exposure. So therefore, the consolidated rating having an indication on expected loss is highly theoretical. But the issue here is how we are going to map all these things into individual obligers, individual facilities. That is the issue. Even though it is a complicated one, we try our best to have an approximation for that. Through that approximation, we would be in a position to arrive at those probability of defaults and the loss given defaults. But you can't do it in a month or so. We need to have historical data, at least for 5 years, to do that. So therefore, what I want to tell you is, many of your organizations may not start these things for the first time. They have been doing these things for a long time. But then you are in a position to get that data. And that data also can be taken into consideration when you arrive at gradings, and the gradings can be mapped to the different probabilities of to that data. That is one way of doing it. The other way is, we have a methodology to arrive at probability of default for asset-based advances. We have gone through that. So there you can calculate the probability of default without the lot of historical data. So it's a parametric method. So you would be in a position to calculate the probability of default. So that is another way. That way is another way of getting into the probability of default. And a primitive method also can be discussed here. Now, if you have non-performing advances data, there are also a possibility to get probability of default, or we call it expected default frequency, calculated. Because that data should be available in your organization for a period of time. Because you have been given loans from the beginning. No? Therefore, the historical data should be there. So I think that is the most possible or most popular way of getting the probability of default calculated. So then you will be in a position to map your grading into a particular probability of default. So that's a rather complicated exercise. In the same manner, through the historical data, if you can get the facility ratings also connected to a certain recovery rate. So that's another complicated issue. But somehow or other you have to do that. So I will just show you the particular ways of doing that. Now, as per this text, under the developing risk ratings, these are the normal probabilities of default connected to the popular type of risk ratings or approximate external ratings. Now, I think if you have this sketch in your mind, it is easy for you to have a rating scale decided. Now, when you say negligible risk, the EDF or the probability of default is 0.01%. If it is very low risk, it's a 0.05%. If it is low risk, it is 0.1%. If it is moderate, it is 0.5%. Average is 1.25 and marginal is 5.5. Now, if the probability of default goes beyond 5%, we think it as a bad loan or risky one. Risky in the sense that risk is not beyond the risk appetite of the organization. You can see here, when you get a special mention type of one that has a 25% probability of default. So that's a big probability of default. Substandard is 50% and doubtful is 90%. Loss is 100%. So that is how the probabilities of default being taken. And now here we have discussed about these things. Right. Now, I think I have just sent you the assignment. So, do you have any issues or any questions on that? You have any questions on that? The assignment?
So this 30 marks is out
Yep.
of 100 marks, so will it be proportionate?
30 marks is out of 100.
Okay. Sir.
Out of 100 is now say your total evaluation is on 100 basis. No, you will get the total evaluation for 100, and the examination connects with 70 marks, and the assignment connects with 30 marks. That is what it means.
Thank you, sir.
Because now you have to take. I think you have to have a big effort for that, because I think that's a real 30 marks. So then you try your best to do the things in a very optimum manner. So that is what I expect. Right? Any questions on that? That's what I am asking. Any type of a clarification? No, because if you want to do it properly, you need to have that knowledge. That is why I am asking that. Today I will explain about that consolidation, because I think you might have some issues with that consolidation, because that consolidation is also a necessary task for you to do. I will just explain it on the board. I think that would be better. So therefore, Now, just look at this final rating and the 1 year expected loss. So, these are the ranges of expected loss for different rating grades. So, this is taken as a final rating. So, that final rating is a consolidation of obliger rating and the facility rating. Now, as I told you, the obliger rating relates to the probability of default. Facility rating relates to the loss given default. When you multiply those two things, you will get the expected loss. So, if you get the expected loss in this range, now say it is 0.00052 to 0.0015. So, that is the expected loss as a calculated basis. And this particular range relates to the rating grade 1. So, that is the best rating, AAA type. Then you have another range that is 0.00 from here to 0.0125. So, that comes to the second grade. So, then you get higher and higher expected losses. The rating goes down. Rating goes down. So, that is how it is being done. So, when you get the obliger rating, now obliger ratings are given, we have already calculated the obliger rating. Now, for those obliger ratings, you have a range of probability of default. Range of probability of default. Then facility ratings also range of loss given default. Those two ranges can be multiplied. And these we can come into these ranges. That is how it is being done. Any question on that? Any question on that? Yes. Today I want to just further give you some more details about the Altman's Z-score model and the new developments of Altman's Z-score model. So today I will discuss on that. I think that is another tool which you can use in your credit analysis, credit risk analysis. So I think those things are very, very important. So I can even though I just put these things in the board or whatever, I have taken it from some text. I can just give you those texts also. I mean, the names of those texts, and then you are also in a position to do a reference work. Now, this Altman's Z-score model basically innovated for coded manufacturing type of corporates. Coded manufacturing type of corporates being evaluated through Altman's Z-score model. And it's that model really deals with bankruptcy, possibility of a bankruptcy. But later, that possibility of bankruptcy is equated with the probability of default. So that is how the things came later. So therefore, I will now show you the first Altman's Z-score model, which has been innovated in the year 1968 by Edwin I. Altman. That is the famous Altman's Z-score model. So that Altman's Z-score model publicly traded manufacturing companies. It really relates to the, or we can check the tendency of bankruptcy or possibility of a bankruptcy of a quoted company, manufacturing company, by using the oldest Altman's Z-score model that was invented in 1968. So I can just put that particular model on the board. I am just giving these things in order to equip you with certain quantitative methods to arrive at probability of default. But there you don't need so much of historical data. That is the advantage here. So that is why I have just put forward this Altman's Z-score model. Altman's Z-score model. That is 1968. This is specially applied for public quoted corporates engaged in manufacturing.
Question.
Very good. Now I will put on the board the Z-score model, and we call it Z listed. That is Z equals 1.2x1 plus 1.4x2 plus 3.3x3 plus 0.6x4 plus x5. Now I will just put x1, x2, x3, x4, x5 like this. Now you have net working capital divided by total assets. X2 is retained earnings divided by total assets. X3 EBIT, that is earnings before interest and tax, divided by total assets. X4 market value of equity, market value of divided by book value of liabilities. Then X5 is sales divided by total assets. Right, now this is the Altman's Z-score model, which is specially applied for public ordered manufacturing corporates. I think you have to be careful when you apply this. It can be applied only for that type of corporates. So this is the original or oldest Altman's Z-score model. And at a later stage, in the year 1995, another model was introduced by the same author, Altman, and that is for private firms. That is for private firms. So then there's no categorization, but whatever. So it just said private firms. So then we call it unlisted type of companies. There's a difference. So it is not the same model to be used for unlisted companies, just private firms. And in sorry, now this unlisted one is also an invention of Altman, but at the same time in the year 1968. But that 1995 thing is another one. So that is a new, we call it new Z-score model. Now that is really for emerging markets, non-manufacturing listed companies, emerging markets, non-manufacturing listed companies. I think in Sri Lanka we can just use that because emerging markets, non-manufacturing. It's not manufacturing, but non-manufacturing, and it should be listed companies also. Now, what do you mean by emerging market? Now, in Sri Lanka is an emerging market. India is an emerging market. So, likewise, you can use these things in such countries, emerging markets. So, I will just give those things. Now, you can note this down. Now, this is the oldest version of Altman's Z-score model. And if I put it as just the other one, now we can say this is A, the B is for unlisted companies. Now for unlisted companies, now I will put that also. Now this is for listed public companies, manufacturing. You can say unlisted. Z is equal to 0.717x. 0.717x 1 plus 0.847x2. 0.847x2 plus 3.107x3. 3.107x3 plus 1.05x4. 1.05. Sorry. 3.107x3. 0.42x4. 0.42x4 plus 0.998x5. 0.998x5. Now this is for unlisted companies. This is also part of Z-score model. But now just make sure that X4. Now X4 is market value of equity. Now the market value of equity can be taken only for quoted companies. You can't get a market value for unquoted companies. Equity is market value. There's no market value for equity for an unlisted company or a private firm. There's a small change in X4 for the unlisted companies. So there you need to take X4 as, here we have taken X4 as market value of equity divided by book value of liabilities. But for the unlisted Z score model, you have to take X4 as book value of equity divided by book value of liabilities. Got my point? Are you clear about it? Now, I have just given you another model which you can use for unlisted or private firms. But even though it is mentioned as X4, there is a small difference in X4. When you compare it with the oldest Z4 model, the X4 is defined as market value of equity divided by book value of liabilities. But for an unlisted company, there's no market value of equity. No. Therefore, we have to just replace that with book value of equity. I think that is understood, no? Any questions on that? Any questions? Yes, there are some questions given here. Anyway, I will explain those things later. Now I just go through this Altman's model. Yes. I think, are you clear about it? Now, you have now gone through the Altman's Z-score model as invented in 1968. I have given the first model which is applicable for a public quoted corporate engaged in manufacturing. For such companies only, this model can be applied. And there's another model. That model is called Z unlisted, and that can be applied for private firms. And they are the same variables being taken into consideration, but X4 has a little difference. Now, in X4 defined as market value of equity divided by book value of liabilities. For the unlisted Z-score model, the X4 is defined as book value of equity divided by book value of liabilities. So I think that is understood. Right. So then we have gone through the second, that unlisted type of Z-score model also. Then you have another one. That model was invented in 1995. It is very, I think, about say 25 years back, in 1995. So we call that Z-score model emerging markets non-manufacturing listed companies model. Now this model is used for bankruptcy forecast. You can see through the Z-score how possible the firm to be bankrupt in 1 year's time. So that is what it means. Yes, any questions on this? You need to note this down. If you are not clear about it, just let me know. Is the board clear? The board clear?
No, sir.
Not very clear.
No, sir.
I will just that equals 1.2 x1. Just follow it plus 1.4 x2 plus 3.3 x3 0.6 x4 plus x5. Now this is specially applied for public quoted corporates engaged in manufacturing. Just follow it that way. Then there's another model for unlisted or private companies. Z equals 0.717 x1 plus 0.847 x2 plus 3.107 x3 plus 0.42 x4 plus 0.998 x5. 0.998 x5. I will repeat. The unlisted Z model is Z equals 0.717 x1, 0.847 x2, 3.107 x3, 0.42 x4, 0.998 x5. So note it down. Note it down in your notebook. Now these things are available in that financial risk text, but I just want to give you this. But the next thing which I am going to give is not appearing in any of these texts. So you have to be careful and you have to note it down. Then I will, shall I erase this? Are you okay with these things? Have you taken it down? Have you taken it down?
Yes, sir.
Right. Right now I will erase these two things. Right, now I will go to another one, which we call Z-score model new, we call it. Z-score model new. That has been invented in 1995. 1995, and it is known as the emerging market non-manufacturing listed companies. Emerging market non-manufacturing listed companies. Now I am asking from you, if you go into Sri Lankan Stock Exchange, can you name one or two companies where we can apply this model? Yeah, we can apply this model. Two companies you have to say. So that is emerging market, non-manufacturing, listed companies. Listed companies. Do you want to have a, you say, we want to have a to get an idea about it. Shall we access the Colombo Stock Exchange website? Or are you in a position to tell me one or two companies? There you can. Sometimes those companies may be your customers. Yes. Yes. Just give a name of a company, one or two, to be used in this model.
Sir, Navaloka Hospitals?
Navaloka Hospital. Yes. Correct. Because it's not a manufacturing company, it's a service company, hospitality industry. Yes, it is okay. Navaloka Hospital is quoted in Colombo Stock Exchange. Yes. Any other?
Dialogue.
Dialogue, Dexia Dials. Yes. There are so many. I mean, in Colombo Stock Exchange now there are 296 companies listed. Out of that, non-manufacturing companies you can select for this the application of this model. I will just give that model. Z equals 3.25 plus 6.57 x1 0.57 x1 plus 3.26 x2 plus 6.72 x3 plus 1.05 x4. Now you can just see there's no x5 here. They have only 4 variables together with one constant, that is 3.25. The constant is that. The same variables are same definitions are applicable here. Same definitions applicable here. So the same x1 up to x4. And here the market value has to be taken because since it is a listed company, so market value of equity has to be taken in the S4. Right. Shall I repeat? Z equals 3.25 plus 6.57 x1 plus 3.26 x2 plus 6.72 x3 plus 1.05 x4. Now, there the x1 is net working capital divided by total assets. X2 is retained earnings divided by total assets. X3 is earnings before interest and tax divided by total assets. X4 is market value of equity divided by book value of liabilities. X5 is sales divided by total assets, but this X5 has not been taken here. It is without X5. Right? Any question on that? So I think in most of the Sri Lankan companies, if they are listed, we can use this methodology to arrive at a set score. Then I will now tell you how that bankruptcy prediction can be made. Because there's a particular way or determination of a bankruptcy through the Z score. So there are ranges given to take decisions on possible bankruptcy. And we call it model interpretation. Right. Any questions on this? I think this is a very straightforward type of a thing. But you
Can you repeat X5, sir? X4, sorry.
X4. X4 is market value of equity divided by book value of liabilities. Market value of equity divided by book value of liabilities. X4. But there's a special case when we use this unlisted model. There you have to apply X4 as not the market value of equity, book value of equity, because for an unlisted company, you don't have a market value of equity. That is why we just replace market value of equity by book value of equity for an unlisted company. So I think that is understood, no? Right. Okay, now I have given you 3 models. The first model is for listed manufacturing corporates. The first model, first Z score model. The second Z score model, or the next model, is for private firms or unlisted companies. Third one, that is a new one that was invented in 1995. That is for emerging market listed companies, non-manufacturing. They say it is non-manufacturing. Now you have 3 different Z models for different set of corporates. And I will now give you the interpretation, model interpretation.
Sir, can you please explain Sri Lanka is non-emerging market or emerging market?
Emerging.
Okay, sir, thank you.
Emerging market, I think if you read through articles in the websites, you will find that Sri Lanka is an emerging market, because under emerging markets, Sri Lanka is in a very lower level. But however, in the global economics magazines or wherever, Sri Lanka is also categorized as an emerging economy. India, Sri Lanka, Pakistan, Bangladesh, all are coming under emerging economies. Now I will give you the interpretation. Model interpretation. Interpretation is expansion. Interpretation. And you have in the middle, is it listed? Listed. Is it unlisted? Is it emerging? Interpretation, is it listed, It's an unlisted, it's an emerging. Now, bankrupt. Bankrupt. You said less than 1.8. For all. Now you can see it's an emerging. Should be less than 1.1 to become bankrupt. Then you have there's a zone of ignorance. Zone of ignorance. Zone of ignorance. Listed 1.81 to 2.99. Unlisted also the same, but there you get 1.23. Then you have another one, non-bankrupt. Third, greater than or equal to 2.9. Greater than 2.9. Unlisted also greater than 2.99. Emerging. There's no value given here. So we can't really confirm that even though this emerging type of Z score coming higher than 1.1, we are not in a position to confirm that they will not bankrupt. We call it a zone of ignorance. But what we can do is we can say if the value is higher than 1.1 for emerging market companies, the danger of bankruptcy is low. That is what we can say. Now, just look at the interpretation. the interpretation for bankruptcy for listed one, 1.81. If the Z score is lower than 1.81, the bankruptcy is on the particular firm is on the verge of bankruptcy. For unlisted also, Z is less than 1.81. The same fate will be there. Bankruptcy is, the firm is on the verge of bankruptcy. But for emerging things, to be bankrupt, it should be less than 1.1. Less than 1.1. But for there's a zone of ignorance where we can't say anything. But we can say the particular companies will survive from bankruptcy. But that is also, you are not very sure. That is why we put it as a zone of ignorance. So the value for listed companies is 2.99. If it is less than 2.99, it can be taken as a zone of ignorance. The matter here is, if you go for your counterparties, your customers, in most cases, the Z comes in this zone of ignorance. That is the case. Very rarely you get a value to take a exact decision. That is the issue with this Z score methodology. I think you get my point, no? Even though we do this quantification of Z, very frequently you get a Z value which would lie in the zone of ignorance. Then it can become a futile exercise. But if you get a value which is higher than 2.99, then you are pretty sure the company is, in the near future, there won't be any bankruptcy. They are very much away from bankruptcy. That thing it is sure. So that is the indication. For an emerging one also, you are sure that when the value is very much higher than 1.1, the possibility of bankruptcy is low. And even listed and both unlisted both, the score is 2.99, not 3. We can say 3. If it is 3 or more, you are pretty sure that company would not bankrupt in the near future. Is that okay? Now, this methodology is a supporting thing for you. Even in your organizations, if you find it difficult to arrive at the probability of default for a certain borrower, these methodologies can be used. And then I just told you to apply another model called Logistic PD model to arrive at the probability of default of a company with a certain set score. If you know the set score of a company, you are in a position to get probability of default calculated. to the Logit PD model. Even though we apply these things, these are highly mathematical and statistical type of models, and there you use high level of statistics and mathematics. So therefore, what you need to do is you need to understand the conditions on which we can apply the formulas. You don't need to derive these formulas. You can apply, but you should know in what circumstances you can apply those formulas, or the conditions on which you apply the formulas. Now, for example, if you have calculated Z by this Z model, emerging market non-manufacturing listed company model, then you have to be careful about your selection. You need to select the appropriate one. If you are not selected the appropriate one, the things will not be the results you obtained would not be valid. That is the issue. Right. Now I will show you something on the Colombo Stock Market website for you. Can you see the Colombo Stock Exchange website on the screen?
Yes, we can see.
Right. So I will just show you something here. Now I will go to the trade summary. Now in the trade summary, you can select companies. Now you can't take ACL cables for this emerging asset calculation. You can take advanced finance for that. Right? Shall we go to advanced finance and see what it is? Right. Now you can just look at advanced finance, and there you get the financials, and you get annual reports. Through an annual report, so you have several reports here. If you take one report, there you get the financials. So you need to go to financial reports, right? It is coming starting with 74, page 74. Statement of financial position is there. Statement of comprehensive income is there. Right. Now you can just see, I can just explain you something. You know, when you say X1, that is net working capital divided by total assets. Now for this type of company, what is the working capital? So you need to take current assets minus current liabilities. I don't know how you can put it. Current assets is loans, no? Loans, say, not
And
the loan, yeah. So that way you can just calculate it. And that is to be divided with total assets. Total assets would be 9 billion something, not 9 billion. Yeah. 9 billion something. So likewise, you can calculate the ratios. You can calculate the ratios. EBIT also can be taken from here. That is operating income before earnings before
and tax.
tax and interest and tax. So I think here you have to get. So likewise, you can just do these calculations. I just want to show you how you can select companies from the Colombo Stock Exchange website and do the type of analysis. Now, if you take these Abans, there are several other companies you can go into. Aitken Spence Hotel Holdings, Alumex is a manufacturing company, Alliance Finance, Amana Bank. So there are several companies on manufacturing type. Asri Hospital Holdings. So that type of things you can take. Asri Surgical. Right. Now through these websites, you can get several type of financial information, and in the calculation of research score also this financial information is necessary. Right. Now I will go to the. Can you see the text on the board? Commercial credit risk overview.
Yes, sir.
Right. Right. Now just look at this. Now the facility grades are given here. I'm just giving you the example here, right? And for each facility grade, the obligor LGD is given here. The obliged LGD is 2.5. Facility grade 2, it is 5. Facility grade 3, it is 25, no? Yeah. Next one, it is 35. 3.5, yes. These 45, 55, 65, yes. It is going up. When the facility grade goes down, because grade 1 is the best, second best is grade 2, likewise it goes. So the facility grade, when you have a facility grade of 1, your LGD would be 2.5. So these things, how do you arrive at these things? That is the issue. So you have to arrive at these things by data, by getting the data, historical data. Then you check the next one, the final rating. The final rating is taken, right? Now 2.5 into 1 is the 1%, no? So then it could be 0.5 into 1. That is 0.0025. Now there are some questions here. We can just look at it and see how we can deal with such questions. Now I just come into this question number 2. In your commercial scorecard, you determine that the facility rating scores as 200 and the obliger score is 1158. Suppose further that according to the commercial credit risk policy, loans must be pass grades, that is 6 or better. How would you evaluate the overall risk of this loan? Right. Now I am just asking you how we can deal with this question. The obliger score is given and facility rating score is also given. So first of all, what we can do is, I will just show you the facility rating scorecard. The scorecard is here. Now obliger scorecard is here. So in relation to obliger scorecard, what is the risk level for this? Just tell me. Now the obliger card is given here. Facility score range is also given here. Now, according to the chart, the question number 2's obliger rating is what? You can give the number. What is the obliger rating number for this? According to this chart. As a number. These are very, very simple exercises. Yes.
Very low risk.
And
Very low risk. It's between 1150 to 134 line.
Yeah. What is the value given?
1158.
58. Yes, 1158. Since it is 1158, it is coming under very low risk category. So as a number, what is it? Rating given in numbers, no, 1, 2, 3, 4, like
2.
is 2. Is 2. So that is the obliger grading. So what is the facility grading?
$200, sir.
Yeah. Facility score is given as how much? 200, no? Yeah.
Yes, so the number should be 6.
Yeah, number would be 6. 1, 2, 3, 4, 5, 6. Yes. And what is the question? In your commercial scorecard, you determine that the facility rating scores as 200 and obliger score is 1158. Suppose further that according to the commercial credit risk policy, loans must be pass grades, that is 6 or better. How would you evaluate the overall risk of this loan? So I need from you 2 or 3 comments on this. Right, now how are we going to start? Initially, what are you going to do to answer this question? Now, according to the policy, the loan should be pass grades. Either it should be 6 or above, 6 or better. But in this particular loan, what is the situation? If you go to the obliger score, it is a good one because you get it as number 2 or 3, no? Yes, it is number 2. Obliger gradient is number 2. Whereas the facility rating comes as 6. Right. So then, in order to get the overall risk evaluated of this loan, how are we going to do? That's the question I am asking. Right. How are you going to answer this question? You might get this type of question in your examination also. Yes. Yes, I think you can try. You can try and see how you can answer this question. Yes, anything you can write or you can talk even. Yes. Yes, I think you try something here. Now, when you look at it, obliger grading comes as 2, facility grading comes as 6. But 6 is in the margin, the borderline. So as per the policy, you should not entertain a loan which is worse than 6. But 6 is the border. But how can you justify this loan to be granted? Even the credit policy says that now you have to go by the both ratings, both perspective of ratings. Obliger rating is one side, so there the obliger is having a good rating, whereas the facility rating is 6. It's a marginal rating, no marginal low, you can say borderline rating. But our consolidated rating comes with the multiplication of both indicators. So therefore, you can say the consolidated rating definitely comes above 6. Therefore, this loan can be granted. The overall risk grading is between 2 and 6. And it is away from 6 to the lower side, so that is 5 or 4. Therefore, the loan can be granted. And as per the policy, this particular proposal is within the appetite limits.
So the consolidation rate should just multiplying or is can
No,
we just show?
multiplying. No, multiplying in the sense, no, even though I say that multiplying, you can't multiply the grades, no.
Yeah.
It's not multiplication of grades. It is the multiplication of indicators. Now say the particular facility gradient, sorry, the obliger gradient is 2. Now there's a certain probability of default in relation to that obliger grading, right? So I will just show you here. I think in the earlier one, we have seen the EDF in relation to the facility grade. Don't take this. If you want, you can just take this also. Now, what we need to do is, we need to get the facility grades corresponding EDF. Now, if you look at this, but don't take this as an example, but I will just show you the mechanism, right? Now, since our loans facility grade is, the obliger grade is 2, right? Just think that obliger ratings, the obliger ratings are given in EDF here. So the corresponding EDF for obliger rating 2 is 10%, is it? 10%. So that is a big one, no? Anyway, I will just go into another one. It's not a feasible one. No, I'm just giving as an example, no, so therefore we can take it. Now what we have to do is, we have to get this EDF, that is 0.1, right? 0.1 to be multiplied with, what is the obliger? Now under 6 you get 55. Obliger LGD is 55. So 0.55 into 0.1. Then 0.055 or something you get. So that comes into a certain final rating grading. You can select it from here. So it might come somewhere here, 4 or 5. You got my point? Because you are not going to directly multiply 2 and 6.
Yes, sir. So now we have to develop this model now, sir.
Yeah.
So up to obliger rating and this facility rating, we can develop the model. So after that, I'm a bit confused how because anyway the final decision would be on the cumulative basis that we have to
Yeah, of course. Yes.
give this what you call the loan is feasible or not.
Yeah.
So that part is not very
No,
clear.
anyway,
I don't
now
know.
you can do it this way. Now these things are actually the final version of this rating model. But in order to get these things done, at least you have to go for 2 to 3 years. Otherwise, you can't just do it. But you can have a model for that. You can have a model for that. That model is, you need to select different EDF in relation to your facility grading. So I can suggest something, because it may not be a 100% correct thing, but I can suggest this type of thing. So what you have to do is, you just do facility gradings for your corporates type of, not facility grades, EDFs, obliger gradings. Now you do obliger grading through your scorecard and say that obliger grading is 2. Then by getting the things calculated, I mean, the Z score, whatever you can calculate through the financial information. Then through that you are in a position to calculate the EDF. So for just to have a benchmark, what you can do is, you can now, so you just develop a facility grading and the obliger grading. I will just put it in it again, right? So first of all, you do this rating exercise and you score your different facilities, right? So when you score the facilities, say as it is, you get the score as 1158, say. Then what is the corresponding obliger rating? It is 2, right? Now what we need to do is, to have a benchmark, you get the financials of that obliger and do a Z score calculation. After calculating the Z score, you will be in a position to arrive at the probability of default by logit model. So then for that particular instance, you can say the facility gradient 2 have a corresponding EDF of so much, probability of default of so much. Is that okay? That's a way. You got my point? Now, for example, now this particular question says the obliger score is 1158. So in your case also, you have got an obliger score with score of 1158. Invariably, that obliger grading is 2. Now, what we need to do now is we need to see what is the corresponding probability of default for that facility grading 2, obliger grading 2. So in order to do that, we can have that particular facilities or the obligers financial statements. Through those financial statements, you can arrive at the Z score. Z score of that obliger. After getting the Z score, you are in a position to get the probability of default calculated, is it? So that probability of default can be, so if you can't do it with one, if you have 3-4 ratings coming under rating 2, obliger rating 2, and everyone you get the Z score calculated and get the average of those Z scores and apply it to the logit model and get the probability of default. So that is one way of doing it. Have you understood what I said? Yes, Uresha.
Yes, sir. The part that to get the set score and the probability of default, yes, sir.
Yeah. Right. So that is one methodology. So it is not the only one. There can be several other ways, but what I say is it is an easy way, because if the financials are readily available, you can do that. And you can't really determine the probability of default for a particular obliger grading by doing that. If you do it for only one obliger, you have to get several obligers Z scores and get the average of that. That average has to be applied to the logit model and get the probability of default. So that is what the way you have to do. It is not that easy. But what I suggest is, even though if you are not doing it, you can explain that has to be done. So, and then you can have some assumed figures and put those things on your tables and say that you have done these things. Got my point? Otherwise, you have to wait for 3-4 years to do this. But if you are not going to wait, you can use this particular model. Either that, or we have discussed about another model also we discussed. Through the model also you can do the probability of default calculator for the particular obliger. But only thing is now those obligers should be asset-backed loans, no? But in the case of a normal loan, we can't do that. Therefore, either you can use the Z score and then Z score. Through the Z score, you are in a position to get the probability of default calculated. That is one way. Or you can go by Merton model and calculate the probability of default. That way you can do. And even LGDs also to be calculated in that manner. But LGDs, I think it is possible for you to get some historical figures for LGDs. Is that okay? Yes, Suresha, are you?
Yes, sir.
If you have any doubt, let me know. I mean, I know that this is a little complicated issue. And even though the complications are there, so you should understand how you can just sort it out. You can sort out. And the other thing is now, when you prepare your write-up with regard to these rating models, you can explain what it is rather than doing it. But doing it is a different case. But the model is you explain the steps. This way you have to do this and do that. That way you give all the details. And those details should be justifiable. That is what you need to do. I will answer some questions. I think some person has asked some questions. So I will do that. Sumudul Dilanga, he has asked instructions in the given assignment. You should design minimum of 2 rating models in order to cater. Yeah. Now the meaning of that is, now we have to have a rating model for each sector. For example, if you develop a rating model for your SMI advances or SME sector, so that is one sector. You can't use that for your housing loan sector or whatever. Right? Housing loans has to be treated separate. Or you can say commercial loans to be, commercial loans in the sense, not the SMIs, say trade finance or something. Such type of things cannot be treated in the same way. That is a different. Now, for example, now I have just explained that I just went through normal commercial type of loans. Then I just said there have to be additional parameters to be taken in relation to commercial real estate advances. So in that way, you need to have 2 models developed. 2 models. One model for one category of loans, the other model for other category. For example, say one model for normal commercial advances, the other model for commercial real estate. So these are the 2 models. So likewise, that is your choice. You can choose whatever you want, whatever applicable. So that all depends on your organization and your requirements. Is that clear? 2 different sectors. That is what it means. That is the meaning of that question. You should design minimum of 2 rating models. A minimum, right? If you want to have another or 3 or 4 models, that is also you are free to do that. No issue. If you are very much interested in this type of things, you can have 3 or 4 models even, or 3 different sectors or 4 different sectors. Now, minimum should be 2. That's what I say. Then the question 5 should establish at least 8 different obliger risk ratings, 5 of which should be in the performing category. That means you need to develop risk ratings, obliger ratings 8. So that is negligible risk, low risk, or whatever that way. But there's a particular point. Beyond that point, those loans are not performing. So that point is, now say you have altogether 8 different rates, 1, 2, 3, 4 up to 8. So then up to 5. Those gradings, if you take the gradings of those loans should be in the performing category. That means 6, 7, and 8 are not in the performing category. Is that clear? Now, my intention is to give you a certain base to do this exercise, rating exercise. I think there's a text on financial risk, text on rating scales and all. And I have given you some instructions on the board also. All those things can be, you can based on all these things, you can make use of all these things to have this exercise, to do this exercise in a good way. And in the meantime, you can see what are the other things you need to do this. If you have any question, you can ask that, and I can instruct you what to do. As Suresh now asked, no, he asked how to just have these type of margins or whatever, the ratings and all. Anything else you need to clarify on that manner? Okay, now we will see this. Can you see the text on the board, on the screen?
So can you please explain, we have to get the financials, then is it score model.
Yeah.
After that, why we need to take Logit PD?
Because now just getting Z score would not answer our questions, because we need to get into the probability of default also. That is why we need to apply Logit model. Now, by just calculating Z, are we getting PD? We are not getting PD, no? Probability of default cannot be taken from Z, no? By just applying that Z into the Logit model only, we can arrive at probability of default. That is why we need to use the Logit model. Is that clear? If you take just Z, it doesn't say anything about probability of default, is it? It gives an indication about the bankruptcy or non-bankruptcy. That's all.
Yes, sir, I got it.
In actual form, this Logit model usage and all developed in later, at a later stage, because this Holtman Z score, as I told you, it was invented in 1968, and later in 1995 there have been several modifications, but in 2006 there was another modification in India. Actually, that was done by Dr. Arindran Mandoghapadhyay from NIBM, National Institute of Bank Management, Pune. So he invented some other model for Indian corporates. That was in 2006. With that, the Logit model usage also introduced by him. So these actually these applications are not in most of the textbooks, American textbooks, but this Logit model usage is more or less introduced by Dr. Arindram from NIBM. So Now say if you just apply these things in your write-ups so you have to just give that you have to quote that this is from this or that. I will just give that quotation also. I will just put it on the board, that particular one. The logit PD or logit probability of default is a introduction of that person. So anyway, logistic regression, there's a thing called logistic regression, and that's a statistical method. That's a statistical method. That method is used to arrive at the probability of default of these loads. That is what we do here. Right, now here you get, I think we have done this, no? This one. Asset Altman's one. Now you can just get this and just do a set score calculation here. I don't know whether total assets is given. Now we can have a break and I will start by 10:50. Right, we had a small delay. Yes. Now I just want to show you again the way we can get the Z values and come up with the logit model to maintain or find out the probabilities of default. We have done it, but I just want to put it in a more explainable form, and it is an explanatory type of a thing where it's not just the formula. I will take some Z values where we can say it is very close to the marginal levels. Now, as it is, I have just given you the interpretation of model. Now, there 2.99 is a very critical value, because if the Z score is higher than 2.99, you can say that it is a firm where you can't see any bankruptcy in the vicinity. Then there are other figures given here. For listed companies, it is 1.81. So then we have to see the significance of these numbers by looking at the Z score model and put it into the logit PD model. Right. You should understand why I am doing this. Now I will go through the limit in numbers. Now we should look at this interpretation chart. There you can see the limiting numbers are 1.81, 1.10, 2.99, and 1.23. Those are the numbers. Those are the numbers where you can see some relevance in the probability of default. Right. First of all, I just get the probability of default calculated for Z equals 2.99. I will do it this side. Logit PD model. Logit PD is equal to 1 over 1 plus e to the power minus. Now I will take when Z equals 2.99. So I have to just look at logit PD. So for that I substitute the values here, 1 over 1 plus e to the power minus 2.9. Right, we'll do the calculations. Now this value as a decimal you get 0.05028. Point 0.05028. 1 over 1.05028. And you get the value as 0.9521. Now this is logit PD. So this is the probability of survival. Probability of survival. So then you get PD as 1 minus 0.9521. That is 0.047. 0.047. So that is as a percentage 4.7%. 4.7%. Right. Now, I did the calculation for logit PD when the Z value is 2.99. Now you see that the probability of default comes as 4.7%. It's a lower probability of default. So that means there's a more than 95% chance of survival. Then we can confirm there won't be any bankruptcy in the near future. Right. So what you need to do now is you just calculate the PD for when Z is 1.81. When Z is 1.81, you calculate the PD. When Z is 1.81. Can you do that now? Felicia, Resha, Damit?
Yes, sir, we'll do.
Yeah. And we can tabulate all these things later on. Now we just calculated the PD for Z value 2.99. Now we are going to calculate it for 1.81. Yes, you can just send the answer. Just send the answer. I want all of you to do it because you get a certain type of a competency by doing those things. And when you want to take certain decisions with regard to this, that decision making would be very much easy for you. Yes, Sumudu. Correct answer, 40.064. Now still 14% of a probability of default would be a higher one, whatever it is. Now we can go to the next term, next value, that is 1.23. 1.23. Just look at it, 1.23. When Z is 1.23, what is the probability of default? Yes, Alicia, 22.6, correct. Now you see, now if you have a probability of default of 22.6, that's a very high probability of default. You are pretty sure that if you have granted 4 loans, 1 loan will become default. Now I think you can just see when Z is 1.10, what would happen. Now we have calculated Z for different values, 2.99, 1.81, 1.23, and the next one would be 1.10. So that is the last one. We can calculate 1.10. So almost, yeah, what is the next one? Yes, Umudu, Uresha, 24.97, yes. It's almost 25. Akshan, yes. Right. Now we have calculated for 4 different Z values the respective probability of default. When it is 2.99, it is 4.7%. When it is 1.81, it is 14 point something. When it is 1.23, it is 22.6. Now, I will, if I tabulate all these things, then when Z is 2.99, PD is 4.7. When Z is 1.81, is 14.06. When it is 1.23, it is 22.6. When it is 1.10, it is 24.97. Now this is the chart. Now you can see the increase, exponential increase. So when it is 2.99, 4.7. When it is 1.81, 14.06. Lower the Z score, higher the probability of default, but it is not a proportionate one. You get an exponential type of an increase. So having a Z score with the minimum, so we can say the marginal difference of Z score will have a very high increase of probability of default. Very sensitive. So therefore, when you calculate Z, you should calculate it for at least 4 decimals. 4 decimals. Because it's so sensitive. So sensitive. Now we will go into the questions again. Because what I need you to do is, you need to develop a certain skill where you can understand the issues and suggest appropriate steps to be taken to deal with such issues. That competency you need to develop. With that in mind, I just give you all these questions and all these type of exercises. So you need to make use of those things. Without actively engage in these things, you would not be in a position to get these things absorbed. So therefore, you all should actively engage in these things. Right. We will see some other questions here. So your arguments, your reasoning and all would be helpful. We will just go through the question number 3. Suppose in your analysis, you discover that the bank providing a standby letter of credit as a guarantee to your borrower has experienced a major liquidity crisis, and it appears that the firm will shortly be forced into receivership. The terms of the contract make it clear that in such events, the guarantee is no longer in force. How would that affect your view of the loan? Now, this is a type of a situation any banker might face. Now, a bank has provided a standby letter of credit as a guarantee to a borrower, and that borrower is experiencing a liquidity crisis, and the firm will shortly be forced into receivership. So the guarantee would not be in force in that case. So then what will happen? Now when it goes to receivership, but what does that mean? So it's a bankruptcy, is it? So that loan would be defaulted, even though it's a guarantee. Now, standby letter of credit is a normal guarantee, and it's a equivalent to a credit facility, even though it is an indirect facility. Because if the borrower doesn't pay, if the borrower doesn't honor the contract, or if the borrower doesn't honor the contract or whatever, then the guarantee has to be liquidated. There's no other way the bank can do. Bank has to just liquidate the guarantee, and the proceeds have to be debited to the borrower's account as a loan for him. But how can the borrower pay the loan if the borrower is in receivership? Yes. Come up with your comments. And what would happen? The bank faces with this type of situation. Yes. Yes, Sumudu, Felicia, what shall we do? I mean, if you face with this type of situation, what would happen? Yes. At least you can give 2 comments. Just give 2 comments on this. Because, even though we do several calculations, if you do not have a basic understanding about the concepts, you can't do anything. It is useless to have so many calculations. If you do not have the basic concepts in the mind, you have to develop your basic ideas, basic concepts. Now, this will give you certain type of factors to think about. The question is, how would that affect your view of the loan? That is the question. So you have to give an answer for that. Actually, I have given a brief description about what is happening. Now, when you say standby letter of credit, it is a type of a guarantee. And it can be considered as a indirect advance. What do you mean by an indirect advance? Contingent facility. Now, when the event happens, when a claim comes, bank has to liquidate that. Then it will become a loan given to the borrower. But since the borrower has already received the receivership, that is what you call bankruptcy, then the particular customer is not in a position to pay back the loan or the guarantee amount. The bank would be in trouble. The bank has to classify that loan as non-performing, and I think it would be, we have to see how we can recover, because we get the preference of, the preferential creditor type of status the bank would get, no? So then we have to go through the recovery procedures. So it's really a default. Really a default. Any other comments? Because this type of things you need to discuss, and you need to put forward your comments also. And for the benefit of others, people can just exchange ideas. Right? I have just given you a certain introduction to this, and you have adequate factors to be think about. Now just look at this question number 4. You have been provided the following information on 2 commercial loans your bank is considering. Which one would you prefer based on this information? Now, the annual net income is given with regard to the loan, amortization, interest expense. Now, annual net income is the borrower's income. Amortization, interest expenses, other non-cash items, principal repayment, interest, lease payments. Loan 2, annual income is 875. Right, I think this you can go through at your convenience. And I will now go to another area where we deal with portfolio of loans. Because in that case, we have to go through the portfolios. And for a financial institution, bank, and that type of an organization, it is equally important to have portfolio management also. Because though you go through individual advances and get the probabilities of default calculated or whatever, it would give you a very limited scope. In order to have a holistic scope, you need to consider the portfolio level implications. Therefore, it is very much necessary for you to do a portfolio analysis. So that we now go into portfolio analysis type of things. Can you see the things on the screen? Introduction to portfolio models.
Yes, sir.
Right. It is important to examine the expected and unexpected loss in the portfolio setting. Portfolio expected loss is sum of the individual expected losses. Now, I think we have done it to certain extent, but I have not gone through the difficult side here. So that's what I'm just taking it again. When calculating the portfolio unexpected loss, it is significantly less than the sum of individual unexpected losses due to diversification effects. The correlation between assets is an important factor in computing unexpected losses. Now, expected loss. Actually, we have gone through the expected loss when you arrive at consolidated gradings, risk gradings, where we went through the probability of default, when we have the obliger grading, and LGD when we have the facility grading. expected loss increases linearly with probability of default. When the probability of default increases, expected loss also will increase. But unexpected loss is a non-linear function of probability of default, and it is uniformly larger than expected loss for a non-zero probability of default. Now you can just see the graph, and that graph actually represents the behavior of expected loss and unexpected loss with the EDF. With increasing EDF for the expected default frequency, for that matter, probability of default, expected loss is increasing proportionately. But you can see unexpected loss, it would increase exponentially. And the expected loss is given as percentage of average exposure. So that is the multiplication of EDF and the loss given default. But if you take it as a expected loss, it increases linearly with EDF. But if you take the unexpected loss into consideration, it increases exponentially with EDF. Now see this, recovery rate, credit quality and EDF. The increasing factor, that is recovery rate, is increasing. Expected loss will decrease. Unexpected loss also will decrease. When credit quality is increasing or enhancing credit quality, expected loss will decrease. Unexpected loss also will decrease. Expected default frequency, when it is increasing, expected loss will increase. Unexpected loss also will increase. Now, for a portfolio, you can just have this unexpected loss. Now, if you have two loans in the portfolio, you have to get the correlation between two loans, correlation coefficient. And unexpected losses to be squared plus 2 rho 1 2 UL1 into UL2. The square root of this will give you the portfolio unexpected loss. Now here it is given UL1, that is the loan 1, unexpected loss. Right, I will explain these things on the board. You have done these things earlier, but not this. The unexpected loss has not been calculated by us. Because here we have taken LGD, EDF, all are like functions, probability functions. Now here the meaning of sigma squared LGD is the variance of loss given default. Sigma squared EDF is the variance of PD, or the expected default frequency. Sigma is standard deviation. Right, I will explain this on the board. Now just look at it. Now this is the expression for the calculation of unexpected loss of a loan. We have done, we have just studied how we can get the expected loss of a loan. It can be calculated by multiplying exposure into probability of default into LGD, into maturity. So that is how the expected loss is calculated. But here, we try to see how we can get the unexpected loss calculated. But if you want to get into a portfolio, say a portfolio might have 50 loans. If a portfolio has 50 loans, we can get 50 expected losses for each loan. And the total of those 50 expected losses will give the portfolio expected loss. But when you get unexpected loss for each loan, the total of unexpected loss for the portfolio, or we call it the portfolio unexpected loss. We can't calculate that by adding all the unexpected losses together. The total portfolio unexpected loss to be calculated with a composite type of a form. Because the reason is, there you have to consider about the correlation between each loan in the portfolio. Now, when you have only two loans, there's only one correlation. Say, for example, you have loan A and loan B in a portfolio. Then what is the correlation? Correlation with A and B. Correlation of returns to A and B. Or correlation of losses of A and B. That is how the portfolio loss to be calculated. Unexpected loss. Because you have to take into consideration the correlation between two loans. If you have three assets in a portfolio, there will be three correlations. When you have A, B, and C loans in a portfolio, there you have AB, BC, and AC. Likewise, you can see with the number of loans in the portfolio, how many correlations would be there. I don't know whether I just gave it that formula. Now say, for example, now you have 4 loans in the portfolio. If you have 4 loans in the portfolio, how many correlations you would get? 4 loans. Say, for example, A, B, C, and D. How many of correlations you get? You get AB, BC, CD, AD, AC. So how many? When you have 4. Yes, now this is an interesting calculation. Yes, now I am just asking you, in a portfolio, if you have 4 loans, how many correlations are there? Now we started with 2 asset portfolio. For a 2 asset portfolio, you have 1 correlation. For a 3 asset portfolio, you have 3 correlations. For a 4 asset portfolio, how many correlations you will have? If I remember correct, I think I have done it with you. I don't know. Have I done this with you? Have I discussed these things with you earlier?
Yes, sir. Yes, sir. N into n minus 1 divided by
Right.
2
Then
divided.
no need of read it again. Anyway, but I have not discussed about the complicated type of formulas. That's what I am now coming into. The formula for getting the unexpected loss of a portfolio. Because when you have two loans, there will be only one correlation term. Now, there the correlation coefficient is signified as rho 1, 2 when you have 1 and 2 loans. When you have 1, 2, and 3 loans, then you have rho 1, 2, then rho 1, 3, and rho 2, 3. Those are the three correlation terms. Right. Now, what I need to do is, I will just show you the formula for unexpected loss for one loan. It is the average exposure into default frequency into variance of LGD. Variance of LGD, then LGD squared into variance of EDF. Now here the ADF is probability of default. Right. Now you can look at it. Right. Now UL1 is equal to AE1 into square root of expected default frequency into variance of LGD plus LGD squared into variance of EDF. Now sigma squared is the variance, sigma is the standard deviation. Right? We can find out the unexpected loss of a particular loan if we know the LGD, EDF, and the variance of LGD and variance of EDF. Now, why we want to have these things? Because we assume that LGD is a parameter or it's a variable. EDF is also a variable. That is why we need to get the variance of EDF and the variance of LGD calculated. Because, time to time, EDF can change. Time to time, LGD also can change. That is why we can calculate the standard deviation of LGD and standard deviation of EDF. Right. If you get these terms, or if you know the values of those things, then we are in a position to arrive at the unexpected loss of a loan. Unexpected loss of a loan. Now, here I have just given you UL1 as one loan. So, UL1 is equal to AE1, that is the average exposure of that particular loan number 1 into square root of EDF1, that is the probability of default of that loan, into variance of LGD of the loan plus LGD squared into variance of EDF. Now this is the formula. Now you have to be careful. This LGD1 squared here comes, but EDF squared doesn't come here. Right. Then I just gave you the portfolio expected unexpected loss when you have two loans. Yeah, you need to calculate UL1 and UL2 both. Not only that, we need to have correlation coefficient between these two loans also. Correlation coefficient also we should know. Right. Right now, you just look at it. Then if you have another loan, that is UL2, that also can be, the unexpected loss also can be, loss for loan 2 also can be calculated like this. Now here it says an asset held in isolation bears both diversifiable and undiversifiable risk. In a portfolio context also, the diversifiable risk is reduced effectively to 0. On the other hand, the undiversifiable risk is the residual risk that cannot be diversified away. The correlation between bank assets is critical to measuring the potential portfolio loss. Intuitively, as the correlation between assets increases, the bank suffers from concentration risk. Default on one asset spills over to other assets, exacerbating the problem. It is therefore important to have reliable estimates of default correlations. Now there are limitations also, so you need to understand that also. When defaults are not normally distributed, a zero correlation does not imply defaults are independent. Correlation is not a good measure of dependence when the underlying variables have distributions that are with infinite variance. To overcome the above issue, a function called copula is defined, which joins a multivariate distribution function to a collection of univariate marginal distribution function. I think these things actually, the theoretical or mathematical statistical part of this methodology, you should not worry about these copulas and all that. But what we need to understand is, this is a type of a tool we apply in the determination of portfolio unexpected loss. Not only that, we need to get some idea about the correlation between each loan in the portfolio. Right. Before going into this calculation, I will I will just give you a simple exercise on the calculation of unexpected loss for loans, two different loans. Right, I will put those things on the board. Right. Now I have given a chart here. The average exposure, there are two loans. Average exposure is 500 million for number one loan. Number two loan, average exposure is 800. EDF for number one loan is 5%. EDF of number two loan is 7%. LGD of number one loan is 20%. LGD for number two loan is 30%. Then we have the variance of EDF, that is 10% for number one loan, 12% for number two loan. And you have the LGD variance also, that is 15% for number one loan, 20% for number two loan. In addition, the correlation coefficient between loan 1 and 2 is minus 0.5. That is also given. Right. What you need to do is you have to get the expected loss of the portfolio calculated. That is number one. Expected loss of the portfolio to be calculated. That is number one. Number two, what is the unexpected loss? Loss of loan 1. Number 3, what is the unexpected loss of loan 2? Loan 2. Number 4, what is the portfolio's unexpected loss? I will repeat. Now, these are the formulas. The schedule is given here, explaining the average exposure, EDF, LGD, and variance of LGD and EDF. Now, number one loan. Is it clear? You can see. If it is not clear, you can follow me. If it is not clear, you can follow me. Right? Average exposure for loan number 1 is 500. EDF is 5%. LGD is 20%. Variance of EDF is 10%. That is given as sigma squared EDF. Variance, this is variance of EDF is 10%. Variance of LGD is 15%. And you have loan number 2. Average exposure is 800 million. EDF is 7%. LGD is 30%. Variance of EDF is 12%. Variance of LGD is 20%. And the correlation coefficient between loan 1 and 2 is minus 0.5. Minus 0.5. So that is given. Now what you need to do is you need to first calculate the expected loss of the portfolio. Expected loss of the portfolio. The first thing you need to calculate is that. Then the second one is what is the unexpected loss of loan 1. Loan 1. Then number 3, what is the unexpected loss of loan 2? Number 4, what is the portfolio unexpected loss? Right. First, you need to calculate the expected loss of the portfolio. So just do that. Just do that. Now, if the things given on the board are not clear, just let me know. Once I gone through the things, and you could have written those things. Yes. Now the first thing is to calculate the expected loss of the portfolio. There are only 2 loans in that portfolio, so it is easy for you to calculate the expected loss. Yes. What is it? Yes. It is a very simple task to calculate the expected loss. Very simple task. Just get the expected loss calculated for the portfolio. Alicia, Lakshan. Suresha? Yes. Now, if you are reluctant to deal with difficult questions, you can do the simple one first. It is very simple to calculate the expected loss of the portfolio because there are two loans and you calculate each loan's expected loss, and the addition of the two loans would give you the expected loss of the portfolio. The figures should be clear, I think. Figures should be clear. Yes. Yes, Sumudu, just get the expected loss calculated for the two loans or the portfolio. Correct. Sumudu got the correct answer, yes. Others also should try, yeah. Others also should try. Yes, Lakshan, Alicia, Suresha. Yes, another one or two should come up with the answer. Yes, Sumudu. Alicia, I think Sumudu has given the answer. You can just go for the next one. Yes, Suresha. Right. Sumudu, now you can go for the next one. That is the unexpected loss of loan number one. Just try to do that. Unexpected loss of the loan number one. Lakshan, yes, we are also correct. Lakshan also got the answer for the first part. Lakshan and Sumudu got the answer for the first part. Others also should try. Most simple one is that. Next, you can go to Sumudu and Lakshan. You can just go to the second part. There you have to calculate the unexpected loss of Alicia. There's a small mistake. We have come very close, but all right. It should be 21.8%. 21.8. Right. Now you try to get the answer for the next part. That is the unexpected loss of the loan number 1. Lakshan, Uresha, are you trying to get the answer?
Yes, I got the first one. I'm doing the second one.
Yeah. I am just waiting for the answer for part 2. There are little complications, but don't worry. Elisha, that answer is for the part 1. Part 2, what is the unexpected loss of loan 1? Just check it up again. You have to apply the formula correctly. When you say sigma squared, the meaning is the variance. It is given here, no issue, because the whole thing you can apply. Sigma squared EDF is given, sigma squared LGD is given. So the squaring is not necessary. Sumudhu's answer is correct. Unexpected loss for the loan number 1 is yes, 53.619. Yes, that is correct. Try to get the second one also. Yes, he got that second one also. Good. Try to do that. Right. I think I am happy that Sumudhu has done the two parts, that is number 2 and number 3. That is unexpected loss for the loan number 1 and unexpected loss for the loan number 2. Sumudhu has obtained the correct answer. Others also should try. Unexpected loss of the loan number 1 is 53.619. Unexpected loss for loan number 2 is 125.984. You can do a comparison now. The expected loss is a very low amount. Expected loss for the loan number 1 is 5, and expected loss for the loan number 2 is 16.8, I think. 16.8 maybe. Yes, 16.8. Now, when you compare the unexpected loss with expected loss, you can see unexpected loss has a bigger figure. Now, for the loan number 1, expected loss is only 5 million, whereas the unexpected loss is 53.61 million. That is more than 10 times of the expected loss. If you go to the other one, the loan number 2, there the expected loss is 16.8, whereas its unexpected loss is 125.98. That is also not up to 10 times, but it is about say 9 or 8 times. The observation here is, you see the unexpected loss is a bigger amount than the expected loss. So now you can try to do the part 4 also. That is the unexpected loss of the portfolio. Felicia, you try to get the answer because try to rework it.
Okay, sir.
Unexpected loss of portfolio 134. Anyway, I will check that. So Mudhu, can you check it again? Sumudhu has got the answer for the final part also, but I think there's a small thin error or whatever. You just look at it again. Others also can try to get the unexpected loss of loan number 1 and loan number 2, and the portfolio's unexpected loss. -0.5 is the -0.5 is the correlation coefficient. -0.5. It is not 0.5, it is -0.5. -0.5. I think somebody has made the mistake there, I think. And it is minus. Uresha, what about the answers?
I got 136.6.
For the portfolio.
Last, yeah.
No, I will do it on the board.
Yes, sir.
Right. Now this is the formula. This is the formula. So ULP is equal to square root of UL1 squared. Now UL1 is 53.619. 53.619 squared plus 125.984 squared. 125.984 squared. Then you get a minus because you get the last term as 2 into rho 1, 2 into UL1 into UL2. So since the rho 1, 2 is minus, you get a minus figure here, minus 2 into 0.5 into 53.619 into 125.984. So this is the calculation. So I will show you the figures here. $53.619. You have to square it. That comes as 2,874.99. 2874.99. 2874.99 plus. Then you have to get the square of 125.984. 125.984. The square. Now you get 15,871.96. 15,871.96. Then you get a minus. I think you would have made a mistake there. It should be minus. Then you get 2 into 0.5 into 53.619 into 125.98. I will do the calculation. 2 into 0.5 into 53.619 into 125.984. That comes as 6,755.13. 6,755.13. Now this is in the square root, under the square root. So we can solve this. 2,874.99 plus 15,871.96 minus 6,755.13 equals to 11,991 something. Now we have to get the square root of that. that comes to 109.50. 109.50. That is correct. Sumudu's answer is correct. 109.50. This is the unexpected loss of the portfolio. Now I just want to sum it up. Sum up the situation. Actually, we got the first calculation. To the first calculation, we got the expected loss of loan number 1. Expected loss. That is 5 million. Expected loss of loan number 2. That is 16.8 million. Therefore, expected loss of the portfolio is how much? 5 plus 16.8. That is 21.8. That you did. Now, afterwards, what we did was we just got the unexpected loss of loan number 1. That we got as 53.619. Unexpected loss of the loan number 2, that is 125.984. And we did the calculation for the unexpected loss of the portfolio, that we got 109.50. Now, if you get expected loss of the portfolio, that is only 21.8. Now you see the unexpected loss is too high. But if you take these two, 53.619 and 125.984, if you add it up, just add it up, you would get about 180 or so. But real portfolio unexpected loss is 109. The reason for that is you have a negative correlation. That is the issue. Now, if you have a loan, if you have loans in a portfolio with negatively correlated, it would really lead to a portfolio with lower portfolio unexpected loss. So that is why what we call diversification. Yes, Sumudu, I think Sumudu made a mistake because he just took it as 0.5 plus. Anyway, I think Sumudu did a good job today. He has done all the things and got the correct answer. You have to keep it up. Others also should try to do it, and you have to put your answers on the table or call messages or whatever. Right. Anything else now? Have you have any difficulty in getting these answers? Any difficulty in getting these answers? You have to be very clear about these formulas, but don't worry now. For an examination, the formulas would be given. If it is a complicated one, now say for example, if you try to see expected loss or whatever, that type of formulas you would not get. That's a very simple one. If a formula is complicated, you would get it in the examination. Anything you need to clarify? Now, just calculations would not help, and you have to look at it in a perspective of, say, physical implications. Or just look at it and see. You have a rather lower type of expected loss, but unexpected losses are high. That is one concept you need to understand. And even the portfolio unexpected loss is higher than expected loss, very much higher. So therefore, banks might face into difficulty through unexpectedness, not the expectedness. So that is the risk managers of banks should consider. But they need to have a methodology to deal with such unexpected losses. The rating mechanisms and all sort of things are the tools for such activities. So you can evaluate your portfolios by having these rating mechanisms. But in terms of a portfolio, the things would be applicable in a different manner. With that, I think we have to wind up today. What do you say? Is it okay now? Any questions on this? Right. With that, I wind up the session, and thank you very much, all of you, for your active participation and questioning and all other comments. And make sure that you correctly get the contents or the concepts, and you try your best to apply those things in your day-to-day work environments and in physical terms. And you should look at it and see how you can make use of these things for the benefit of yourself, for the benefit of your organization, and for the benefit of your country. Because I must say that it's not to be mentioned that these days the country is in a real bad shape. As financial analysts or bankers or financial people, you should take so much of trouble and take efforts to put the country into a better place and try to just get out from this troublesome situation. You might have some innovative ideas towards that. You can pool those ideas and just do something. That would be a great service to the country.